Greetings. So they asked me to talk about the international economy, and I thought that the most interesting part of the international economy is the euro area. So this discussion will be just on the euro area. And again, the usual caveat, if I say anything controversial, please realize it's just me and not the bank. So the euro area crisis looks like a balance of payments crisis. So in the newspapers, it's all about fiscal policy and banking issues. But I think you can get real insights into thinking about it as a balance of payments crisis. It has all the signs of it. You had easy foreign financing, encouraging borrowing and spending, fueling an economic and financial boom. The bubble pops when foreign investors flee. And the economies have to adjust as foreign investors stop lending. So basically, they have to bring spending in line with income. They have to get imports and exports to grow relative to imports and net exports. And they have to figure out how to deal with financial inflows that can no longer exceed financial outflows. And then the issue is, well, is it enough to get back to not borrowing, or do you have to start lending, that is, paying down the debt you've accumulated over time? So these are the periphery current account balances, which are now moving close to zero. So you can see in 2011 that Greece and Portugal had current account deficits of close to 10% of GDP, Spain and Italy at 5%, and in 2 years, they're now close to zero. So what that means is that Greece and Portugal were spending domestically 10% more than they were producing. So they had to borrow 10% to keep their economies functioning at their current levels. And they've now gone through a very difficult process to bring their spending down relative to their income. So how did this adjustment happen if you look at exports and imports? Well, exports in Spain, Portugal, and Italy have all gone up 10 to 15% since the end of 2010. The only outlier here is the exports of Greece. Greece has not been able to increase their exports, which is one of the reasons they've suffered by far the most of the other periphery countries. Imports in Portugal and Greece are down 10%, so if you're spending too much, a lot of that cutback in spending is going to spill over to imports, and so that's where you're getting the adjustment. Although Spain and Portugal have not really had much of a change in imports, and part of that is because over this 2-year period, the price of oil has gone up substantially. Germany, which is this engine of trade growth, has had imports and exports grow up by 10%. And the euro area exports as a whole have gone up by 15%. So what's gone on is that periphery countries have been helped by selling to the rest of the world. They've been selling to the United States. They've been selling to Asia. They've been selling to oil exporters. And that's really helped them kind of grow while the rest of their economies have been suffering. So frequently we talk about current account balances as imports and exports and net income. But the amount of borrowing that a country does is really reflective, again, of spending and income. And so one way of looking at that is how the amount of borrowing is the difference between how much you're saving and how much you're spending on plant and equipment. So we look at this investment saving gap as a measure of a country's borrowing. And so for this adjustment to happen, investment spending has had to fall relative to domestic saving. So investment spending as a share of GDP is down 3 to 5 percentage points in Greece, Italy, Portugal, and Spain since 2010. So what that means is that they're falling much more than the rest of the economy is falling when you're doing it as a share of GDP. It's a pretty dramatic fall. And it started out in a low level because they'd already had a collapse in investment spending from 2008 to 2010 due to the global financial crisis. So for these countries, that's kind of a bad sign because it means less investment in productivity, and if they're going to grow again, they're going to really need to export, and that's going to require higher productivity. Now, total saving, which I calculate here as public and private, is up 5% of GDP in Greece and Portugal, but it's little changed in Spain and Italy. So whatever progress they've been making on the public side, they're losing it on the private side. And Germany has had little change in investment spending. So they're kind of going through this whole crisis without really having to make any adjustments. So in fact, Germany's current account is unchanged. It's equal to like 6% of GDP. So that means their spending is 6% less than their income. And they're lending to the rest of the world. And now instead of lending to Portugal and Spain, they're lending to Japan and the United States and Latin America. So the problem is the imbalance of payments. The adjustment is always on the borrowing side. The lending side really feels no pressure to change their behavior. So if you really wanted adjustment to be easier in Europe, you really want the Germans to be doing the exact opposite of what the Spaniards are doing. So they should be pursuing expansionary fiscal policy. They should be going to vacations in Greece and Spain. And in fact, they're not. They're not being profligate. Their consumption in real terms has been level for the last 10 years. So they really taken this whole German, save up and don't be wasteful to a good extreme, but it's really made the adjustment for the rest of the periphery more difficult. So it's happening with the rest of the world, but it'd be faster and easier if they could sell more to Germany. So I'm going to switch gears and talk not so much about exports and imports, but now on the other side of the balance of payments, this is financial flows. So, you had this capital flight that occurred starting in 2010. So foreign investors started calculating tail risks, so unlikely events, in this case, the euro breaking up. But if the euro were to break up, it would create havoc and turmoil, so you had to start adjusting to that. Well, that just meant that they started pulling out of Spain and Italy and Greece and Portugal. And that drove up yields in these countries. So this capital flight, this fire sale of assets, kept going in 2010, 2011, and then pretty much stopped in the middle of 2012. And it's usually attributed to two developments. Draghi made a statement that the ECB is ready to do whatever it takes. And you should go and look at this on YouTube. It's like one line in like a lot of lines, and you could have easily missed it if you weren't paying attention. But when he said it, it went out, and that really calmed markets in terms of Draghi saying that the ECB was willing to stand behind the euro. And then following that in August, they announced something called Outright Monetary Transactions Program, and that would allow the ECB, in order to facilitate the monetary transmission mechanism, to buy sovereign bonds in Spain and any country that asked for help. From the ECB's perspective, they've got interest rates at zero, but interest rates seen by a Spaniard were going through the roof. So they felt justified to do some kind of program to be bringing interest rates down in Spain, because what they were doing in terms of policy was having no impact on Spain. And so this program has actually never been implemented. Spain or any other country is not asked to be a part of it, but just the fact that it exists has calmed markets substantially. So you can see this. This is the balance of payments data. So if you look at the left column under net, this is net sales of portfolio assets by each country. So in Spain, you can see, for instance, that people were pulling $28 billion out of portfolio assets in Spain, and that it really accelerated in the first half of 2011. So these aren't annualized, so it was a really big jump. And then, lo and behold, after the ECB actions, money started pouring back on net, pouring back into Spain. And similarly for Italy. Now, what I've also done here is I put inflows and outflows. So inflows, the negative number, negative 66, that's foreign investors selling Spanish portfolio assets. And then in the second half, they started going back. And why are they going back? Because, as you would expect, the yields are so high. It is attractive once you reduce the tail risk of the euro breaking up to start pouring money back into Spain. What's interesting also is the outflows. So these are Spanish investors selling maybe German bonds because they need the liquidity, but also selling other periphery bonds if the Spaniards are also holding Italian bonds. But the fact that it occurred also in 2012, they're facing a liquidity crisis, and why not sell your German bond bring it back home, and kind of improve the liquidity of your position. So let's put this in the context of the balance of payments in total. So the financial account is the mirror of the current account. The financial account plus the current account equals 0. So if for instance, the 36 in the first column, that means that the Spaniards were borrowing. So the 36 billion represents a current account deficit. And you can see when it turns to a negative, that shows that Spain is having a current account surplus. So the second column from the left is what I just showed you, the portfolio. I'm going to skip the middle column, even though it's rather dramatic, and go to net other. Net other is mostly banking. So it's just not people selling their portfolio assets. The banks are pulling out of the periphery. So you had private financial investors getting out of the periphery, and yet you were still able to finance the current account balances. And what that was is that there's a mechanism inside a monetary union, a payment system, a settlement system called Target 2, which automatically financed the current account balances when they were in deficit. And that's actually what's the interesting part. This is a balance of payments crisis inside a monetary union. And the way that operates is that it automatically finances the current account going forward. So let me explain this. So this was a Target 2. This was a very provocative thing to try to understand. I have little background in payment systems, but in understanding the euro area crisis, you had to figure out this whole settlement system. The settlement system, in fact, also exists in the United States between Federal Reserve banks, but there's a difference between Federal Reserve banks in one country and central banks in different countries. So to try to explain this as succinctly as possible, countries experiencing a net payment outflow are automatically extended credits from other euro area central banks. So a shift from a Greek bank to a German bank creates a Bundesbank claim on the euro system and an equal Bank of Greece liability through the Target 2 settlement system. So just like in a balance of payments crisis, foreign exchange reserves are flowing out if you have a fixed exchange rate. You had the same system here where essentially money was flowing out. The bank's reserve money instead of foreign exchange money. The bank reserves were flowing out, and it was managed because inside of monetary union, you can't differentiate between a euro that comes from a Greek bank and a euro that comes from a Dutch bank. So the German bank can't say, oh, I'm not going to accept Greek euros because I'm not sure you're going to be around. It's still a euro. And so to make the system operate, just like we have in the United States, you can have these imbalances. But as you see from the next chart, it got a little freaky for a while. Okay, so these are two different balances. The red on the left shows you the sum of Germany, Netherlands, and Luxembourg, where people were sending their cash. And then you have the Italy plus the P4. And you could see the imbalances were getting to be $1 trillion in terms of the two sides. And particularly German economists were raising red flags and, we're automatically financing these current account balances, deficits, and it's wrong. Now, the two things to remember, they weren't the liabilities of the Germans, or these three countries that are the ones extending the loans. It's a joint liability of all the central banks in the euro area. So if all the money goes to Germany and Greece pulls out of the euro, it's not Germany's responsibility to make up for that difference. But what I think it also shows that if there is no tail risk of the euro breaking up, bank flows will go back because, again, interest rates are so much higher in the periphery. And so what you've seen in the last few months, the tail risk dissipating about the euro breakup, that people are sending money back to the euro area, to the periphery. So again, in balanced payments, essentially you don't have to borrow from the rest of the periphery or the rest of the world. You're no longer seeing bank reserves flowing out of these countries. And so you basically have brought spending in line with income, and that helps with growth going forward. Imports can now grow as long as they're growing in lockstep with exports. And investment spending can kind of grow with the economy. It no longer has to keep falling relative to the rest of the economy. But I'm going to end this discussion with kind of all this other stuff going on, the headwinds. So these are what's largely in the news, the fiscal policy. Governments are implementing tighter fiscal policies, and there's a question of how successful these are. And then you have the banking system, which is deleveraging in response to deposit flight and lower asset prices. So the debate on the fiscal multipliers. So a multiplier, just for those, so multiplier 1 means that a 1% drop in government spending or an increase in government taxes lowers GDP by $1. And estimates are all over the map. It's really hard unless you had some really clever model to figure out, keeping everything else the same, you change fiscal policy, what that does. So their estimates range from like 0.5 to 1.5. You have these debates on whether taxes should have the same multiplier of spending on investment. It's a really difficult issue. But we do think that the multiplier is pushed higher when monetary policy is constrained. So again, you have in the periphery these countries implementing contractionary fiscal policies, and yet interest rates are so high because there's been a breakdown in the monetary transmission between what the ECB is doing with interest rates near zero and what the banking system and investors or businesses are facing in the periphery. And also if you have a fixed exchange rate. So one of the mechanisms of tighter fiscal policy might be that a country could pursue expansionary monetary policy to offset it, which you can't do when you're at the zero interest bound. And if you had looser monetary policy, that would cause your exchange rate to weaken, which would boost your exports. But most of their trading partners, all their major trading partners are within the euro area. So, the question is, if it's higher than 1, then you can keep cutting or tightening fiscal policy, but you're losing it because your economy is shrinking at the same time. So you do a calculation of deficit as a share of GDP, you just have a hard time making progress. And that's what we've seen. We've had 2 or 3 years of very difficult fiscal adjustment in these countries. And the periphery countries are having deficits around 4, 5, 6, or 7% still of GDP. The only exception is Italy, which always has had a relatively small budget deficit. So there's this question of how long can they continue this, the political turmoil that you see in the newspapers, the strikes, and whether this really is the right strategy. So the IMF has actually been coming out saying that perhaps this draconian year after year fiscal cutting where the economy is weak, so the deficit to GDP doesn't improve enough, so you have to do more fiscal contraction. If that's just an endless loop that's just not successful, then maybe you should somehow get out of that. But getting out of that is the hard part, particularly if you don't want to scare foreign investors. So the second issue is banking. So the banking system in the periphery took tremendous losses, right? So what's their safe asset in Greece and Spain? Their safe assets were holding government bonds. So when interest rates go up on the government bonds, the market value of those assets just tanks. And at the same time that their safe asset is losing value, the loans you're making are being written off. So their balance sheets just took a terrible hit. And so now they're trying to increase capital ratios. So that means you make fewer loans. If a loan comes due, you don't renew it. You have to raise capital, which makes you even more cautious. And so if you're trying to get these economies to grow again, it's hard if the banking system is still trying to get itself out of the hole from holding a safe asset. The other thing is deposits withdrawn with worries about the government guarantee. Tomorrow you'll have some discussion on shadow banking in the financial system. What's the key thing? Key source of financial stability is if the banking system has deposit insurance that everybody agrees and everybody accepts as viable. Well, if you're a Greek with a deposit in a Greek bank during the height of the crisis, you had every reason to be concerned that tomorrow you wouldn't wake up with your deposits being redenominated in drachma. And you also had to worry about whether the government, if the government tried to pay back in euros, could pay back in euros. So once you have the government no longer being seen as a safeguard, then the whole banking system kind of unravels just the same way the U.S. banking system unraveled in the 30s, in the same way U.S. economy suffered when the shadow banking system was seen as not having kind of a deposit insurance scheme. So how has the euro area responded? They've created something called a single supervisory mechanism in which the ECB oversees large banks. Before, each country was responsible for their banks. So the Germans were responsible for propping up their banks, so they wanted to be the ones managing their banks. The problem we're running into is the Germans don't want to be responsible for Greek banks because they didn't, we didn't supervise them. Why should German taxpayer money go to prop up a Greek bank? So this is an attempt at a banking union, which is going to be a long and difficult process where the ECB, as kind of a any individual country authority, regulates banks. So if a bank goes under, it's not because of a particular country's supervisory authority messed up. And the whole point is to somehow get it so that a bank depositor is comforted by knowing that the whole euro area is supporting their bank deposits, just not their sovereign. This is going to be difficult. The German taxpayer is always going to be reluctant to send their money to prop up another banking system. And the whole issue of deposit insurance, where you have an FDIC for all of Europe, these are very difficult issues and fascinating, but they're not going to be solved anytime soon. So I'm just going to end up with the whole idea of what's going on in the euro area, which is also true of what's gone on in the United States. The paradox of thrift. Great explanation for what goes on. One person's spending is another person's income. So deleveraging puts downward pressure on national income. And so the whole point of Keynes's discussion is that government needs to save less when consumers are saving more. So the public and private sectors throughout the euro area are cutting back spending. And so for there to be a recovery, this has to stop. Again, if you have a crisis and everybody in Greece realizes that their future is dour or whatever, then why go out to a restaurant? Why buy a car? Well, going out to a restaurant and buying a car is somebody else's income. If you all jointly decide to start saving, then the economy really just spirals downward. And that's what we had in 2008, 2009, and that's what the periphery is still dealing with now. And I always like this one. This is in 2009, the IMF World Economic Outlook had a nice chapter on recoveries after a financial crisis, and they tend to be sluggish. So they tracked 88 banking crises from 75 to 2002, and on average, countries do not rebound to their trend over time. So I think they did it over 8 years. So you have this growth, you have this drop down, your growth recovers, but you don't have extraordinarily fast growth to kind of get you back in the path you were before. So in the cases where countries 30% did rebound. There are countries that pursued aggressive fiscal policy, which not really an option for the euro area periphery now, or they have strong growth by their trading partners. But again, they're selling to each other. Spain is selling to Portugal, Portugal is selling to Spain, and they're trying to say, we can't buy any more of your stuff. So here's a nice chart. So interquartile range, you can see that there are some cases where you recover the gap, but frequently you get a gap of like 5 or 10% between the growth path you were on and where you're at. And a banking crisis is just a really phenomenally difficult one to get out of. Now, the IMF chapter doesn't really go into an explanation, but I think it's just this whole deleveraging. It takes you a long time to kind of get back, and once you get back to a debt level that you're happy with, you're very reluctant to go back on another spending spree. And so you just drop down to a lower range. So this was kind of covering a lot in terms of what's going on in the euro area. I think it's a fascinating case if you're teaching students, both in a balance of payments, in a monetary policy, in a fiscal policy, even in a payment system. There are all these issues that are related that are all what we're talking about in the euro area. So we've seen progress in reducing the imbalances. Spending is now in line with income. Investment spending can grow with the rest of the economy. They've had strong export sales to the rest of the world, and they had an end of capital flight. But this whole thing about tighter fiscal policies, the private sector's deleveraging at the same time, and there's a question of, will there be an effort by private investors to still slowly be pulling out of these countries, which require these countries to have current account surpluses to pay down their external debt. So that was a fast and hopefully not too dirty summation of the euro area.